If I ran a hedge fund today, here's exactly where I'd put the money. 8 long positions, 3 shorts. One goal, beat the S&P 500 by 10%. I did the research, I studied what the smartest money on Wall Street is doing right now, and I'm going to break it all down for you in the next 4 minutes. Let's go. Before we get into picks, you have to understand the battlefield, because right now the market is sending mixed signals. The S&P 500 and Nasdaq are sitting at or near all-time highs, while oil briefly hit $100 a barrel today. Meanwhile, OpenAI missed its revenue and user targets, sending shockwaves through tech. Fed rate cuts for 2026 are priced out, but S&P earnings growth is still hitting 16%. Here's the key insight. The easy money is gone. You can't just buy the index anymore. You have to be surgical. That's what hedge funds do, and that's exactly what we're doing today. Oil is the clearest trade in the market right now. WTI crossed $100 for the first time since 2022. The Strait is blocked. Trump rejected Iran's peace offer. There is no end in sight, and energy stocks are printing money. First, ExxonMobil, 10% allocation. It prints cash at $100 oil, and you get a 3.8% dividend while you wait. No-brainer. Next, Chevron, 8% allocation. They report Friday and just authorized a $20 billion buyback. Another cash machine. Together, 18% of the portfolio goes into energy. This is the highest conviction macro trade on the board right now. The OpenAI chaos created a gift. Wall Street panicked and sold everything AI, creating a massive opportunity. Meta platforms, 9% allocation. Unlike OpenAI, Meta's AI actually makes them billions through ad targeting. Revenue is growing 20% plus. Equinix, 5% allocation. A data center REIT that benefits from AI infrastructure demand with zero OpenAI exposure. Then there's Intuit, down 44% on disruption fears. But the most recent quarter showed revenue up 17% and an EPS beat. Morgan Stanley says this is the clearest value disconnect in all of tech. The market is wrong on this one. When the world is uncertain, you want quality businesses that keep growing no matter what. JP Morgan Chase, 7% allocation. No rate cuts means fat margins all year. It's a hedge fund favorite for a reason. Visa, 6% allocation. Double-digit revenue and income growth. Billionaire hedge funds are loading up on this. And GLD, the gold ETF, 6% allocation. War, inflation, and zero Fed cuts make this a non-negotiable position. This is what separates hedge funds from everyone else. We don't just go long, we short the losers too. First short, Oracle, 5% position. 2 tied to OpenAI deals that are now in question. More pain ahead. Second, CoreWeave, 4% short. It IPO'd on OpenAI hype, and that entire revenue thesis is now at risk. Finally, Spotify, 3% short, crushed today on weak guidance with no catalyst to recover near term. So that's the full playbook. 8 longs, 3 shorts. Energy, AI value, defensive quality, and tactical shorts. As Michael Arone says, the biggest risk right now may be staying on the sidelines too long. Remember, this is for educational purposes only. Always do your own research. I'm not your financial advisor. But if I were running a hedge fund today, this is exactly where I'd be. Let your money fly. Drop a comment. Which pick do you like the most?